how does that structural history and how does your capital supply dictate to you how you run your organization and how you think about engaging with the markets? How does that inform the kinds of products you can offer and really the role you can play in the market, given where you sit in relation to government, what your policy mandate is, and what your capital sources are? Somebody want to, Jeff, go for it.
I think one of the things at the Infrastructure Bank that we've, again, because we had this history of a state revolving fund, one of the things that we've had to fight, I guess, to a certain degree, is the mentality of everything is done as a revolving fund. And, so the new program, yes, that's going to be a revolving fund. That program will be a revolving fund. Well, the reality is that, is somebody that issues AAA securities out of those revolving funds, I'm a bit reluctant to do something that's not a AAA. And also, I think there's other ways to attack the problem and approach the problem that may be slightly different than the historical revolving fund mentality. And one of the things that's happened, again, because of the history of the bank, is a lot of our procedures and processes and regulations are all around a revolving fund structure, which really are not very appropriate in some of the new programs we're going to be doing. And when we look at the Efficient Building Fund, we don't have the capital that's been contributed to us in a way that we can create a revolving fund. And so we've had to think about how can we really attack that. The other is, you've heard perhaps ad nauseum, Rhode Island is a small place. We only have 39 communities. When we're looking at some of these transactions, we don't have a broad number of customers and clients within that, transactions within a pool, so we don't get the same sort of pooling treatment that others might, certainly some of my bigger cousins might in terms of their transactions. So that's part of what we've had to take a look at and try to overcome, is a bit of the mentality of, well, this is the way we've always done it, this should be good for the new programs, and how do we bring new and innovative structures and uses of private sector capital, and again, our limited capital, both that's been contributed to us and what we already have in the bank, as we're trying to grow to be a self-sustainable entity.
Great, so why don't I jump in? So just taking a quick look in terms of our organization. So we are an entity here to support the public policy objectives of the state of Connecticut. So in terms of the goals that we operate under, so the first is to attract and deploy private capital to help the state meet its clean energy policy objectives. So this comes to a lot of the basic principles we think about in terms of green banks, which is making sure we are crowding in more private investment in our clean energy economy. So that's the first goal we look at. The second is leveraging limited public funds that we receive to attract multiples of private capital investment, and then we hope that the use of the public funds comes back to us over time. So we don't just want to grant them out. We want to ensure that the market's growth isn't reliant on government subsidies, because it can grow, it can stagnate. We want to allow that growth to continue in perpetuity. The third goal is to develop and implement strategies to bring down the cost of clean energy in order to make it more accessible and affordable to consumers. And I think the key there is ensuring that we provide 100% of the capital needs for clean energy improvements up front and delivering customers immediate positive cash flow value. That's the trick, right? We've learned from the solar PV lease model that if you can deliver economic value today, that will drive consumer demand. So we need to work to do that. And then the last goal that we've really been working on lately, and we're hoping to roll this out in our next comprehensive strategy, is to support affordable and healthy housing for low to moderate income households by reducing their energy burden and addressing health and safety issues in their homes. So we want to ensure that clean energy is available to all. And we'll talk about some of our statistics in defining that problem in a second. But in terms of how we look at the different products and programs we invest in and the specific rates of return, I think Richard Kaufman probably says it best when you want to operate within one standard deviation of the mean in terms of where the capital markets are going to likely lend. So when we think of rates of return, if you think about specific products, I'll give you a few examples. One is a solar loan product. In Connecticut, we have a really high goal of solar PV deployment. We hadn't seen a customized loan product. Back in 2012, 2013, we worked through an RFP to identify a cool company called Sungage Financial. They now operate in a number of states. They developed a customized loan product, 15 years, 6.49% interest rate, unsecured. It amortizes the ITC value, so it really provides a lot of interesting features to it. We used the full suite of green bank tools in this transaction. So literally, we provided a credit enhancement, subordinated debt, warehousing, and eventually securitization to sell those transactions off through bundling to others. This was the first crowd-funded residential solar PV transaction to Mosaic, $1 million. We recently sold off $2.5 million of those loans to the Reinvestment Fund in Philadelphia, CDFI. And that product graduated, so it's now, SunGage was offered $100 million of commitment from the Digital Federal Credit Union in Massachusetts to offer that product in New York, New Jersey, Massachusetts, California, Florida, Texas, and Connecticut at the same terms, but without the state's credit enhancement. So for us, that was a perfect example of how you be a catalyst and you allow the market forces to work. A second example would be our CPACE program. So as I mentioned before, we used 100% of RGGI allowance, cap and trade allowance proceeds. We were able to develop affordable interest rates, 5% to 6% based on the term, 10 years to 20 years. We securitized a bundle of $30 million of those transactions to Clean Fund. Then we followed that up with a public-private partnership with Hannon Armstrong at up to $100 million. And the interesting thing about the Hannon transaction is they've also eased the financial underwriting. So what's happening here is we're not only bringing in affordable and an accessible private capital, but the terms under which these loans or assessments gets underwritten is eased up. So it makes it easier for the customer to access these funds. So we're now seeing in Connecticut other lenders coming in. Greenworks Lending is also coming into Connecticut. So we want to make our markets more accessible to private investment, and that will help us drive clean energy growth in and throughout the state. So a couple of examples.
I'll go next, if that's right. So since we were originally formed through the Michigan Public Service Commission and then the Michigan Agency for Energy, we do have a commitment to make sure that we cover Michigan, and that's it. As far as that, and then so we really focus on making sure that we work with as many local credit unions, local lenders, local contractors as we possibly can. But being an independent nonprofit, we have a lot of flexibility in the programs that we design, and we can really take a look at the marketplace and see where those gaps are and figure out what we want to design to address those gaps. We're not, we don't have to get approval from the Michigan Public Service Commission. The funds are available to us in perpetuity, and so we can kind of leverage those wherever it makes sense to leverage them. At the same time, Jeff mentioned, it's a kind of small pool of money, right? And so over time, we have to make sure that we're using those funds, we're recruiting additional funds to, like Bryan said, what we would really love to do, we could claim success if our lenders would offer the same rates, the same terms, without our loan loss reserve. So that's when we know that the market transformation has taken effect and we're able to claim success. I think there will still be a role for Michigan Saves then to pull all of those players together, but the more history we have on how these loans are really good loans, they serve a very, very important need in the marketplace, and the more that we can convince our lenders that that's something that they want to do without our loan loss reserve, I think the better off we'll be.